Welcome to the Controllers Council 2023 Economic Outlook and panel discussion. My name is Neil Brown, Executive Director of the Controllers Council. And let's take a quick look at the agenda for today's webcast. We'll have some introductions of our expert speaker, quick word about our sponsor, and then we'll get right to the presentation. And just a couple of housekeeping items. We'll have question and answers, so please use your GoToWebinar control panel to ask questions. And a couple of housekeeping items. You will receive an email with a link to this webcast, so no need for notes. So with that, I'd like to introduce our speaker, Dan North, Senior Economist, North America for Allianz Trade. He's been with Allianz since 1996, and he's used macroeconomic analysis to help manage Allianz's risk portfolio of more than $150 billion in annual U.S. trade transactions. He's appeared on CNBC, Fox Business News, Bloomberg Radio and Television, and quoted by Businessweek, the Financial Times, NBC, the BBC, the New York Times, and the Wall Street Journal. After having predicted the 2008 and 2009 recession and its implications accurately, Dan was ranked 4th on Bloomberg's list of the top economic forecasters in 2010. Dan holds an MBA from the Wharton School of Business. So before we get started, I'd like to just tell you a little bit about our sponsor, Allianz Trade, a global leader in trade credit insurance and your partner for trade risk insights and cash flow protection. Allianz Trade can help predict trade and credit risks and protect your cash flow. Backed by Allianz with more than 125 years of expertise, Allianz Trade global business intelligence is unrivaled, using technology-driven processes to generate insights and present actionable information to businesses of all sizes and in all sectors. So with that, I'm going to turn it over to Dan, and we'll have just a brief delay here, but bear with us. Dan, the presentation is yours.
Very good, Neil. Thank you very much for that kind introduction, and thanks to everybody who were tuning in today. Really appreciate the chance to speak to you. Neil has given a pretty good outlook of what we do at Allianz Trade, but I'd like to fill in a few more blanks. We are the world's largest provider of trade credit insurance, and basically the way it works is, if you're a business that sells to other businesses on open account, you send your goods and services to that other business and hope to get paid back in 30 or 60 or 90 days. However, you run the risk that during that time period, the business you sold to will go bankrupt and not be able to pay you back. We protect our clients against that. We protect them against non-payment. We've been around for over 100 years. We have offices in 52 countries. We have 5,500 employees. 62,000 clients worldwide, and there are a lot of other numbers on this slide here. But the one I like is down in the lower left, 1,000 claims indemnified every week. Trade credit insurance is a discretionary purchase. It's not like auto insurance that you have to buy to drive. So we have to show our clients value by paying claims. Every CEO that's ever been in this business insists on paying claims because that's the only way we can show value. That's what we do. Now, since we're trying to protect against default, businesses not paying back, we try to get a big macro view as well as our analysts who look at companies. And that's what I do, is look at the macro view. And I'm going to start talking about the positives in the US, because quite honestly, there aren't a lot of them at the moment, and then we'll move on. So here's the first positive we have. The labor market is still strong for now. Now, that chart over on the left represents the two big numbers that are shown every month in the Labor Department. The brown columns are the number of jobs created that month, and the blue line is the unemployment rate. So you can see that the brown columns, here's where we shut down the economy and lost 22 million jobs. And then we regained a lot of the jobs. And since then, on average, we've regained 500,000 jobs a month. That's compared to the previous long-term average of 200,000. So that looks great, and it is good. But keep in mind that when you lose 22 million jobs, we haven't barely created any new jobs. We basically have recovered all of those jobs that were temporarily lost. So the next time you hear someone say, oh, 200,000 jobs created last month, that's terrific, take it with a grain of salt. Also take with a grain of salt that blue line, the unemployment rate at 3.5%, near a 50-year low. The unemployment rate, you have to understand what it is. And what it is you're defined as unemployed if you're looking for a job and you don't have one yet. If you're not looking for a job, you're said to be not participating. You're not in the unemployment rate calculation. So you can have very low unemployment rate and still have, a very low participation rate. And that's what we have on the chart on the right. It's a simpler idea. It's the percentage of the population that's actually driving the economy. And you can see we haven't quite returned to pre-pandemic levels, that's 63.4%, but we're getting there a little bit at a time. Now, the difference between that 63.4 and 62.3 doesn't seem like much, but in this measure it is. In this measure it is. Keep in mind, again, that unemployment rate has nothing to do with the people who aren't looking for a job. Those people are not participating. But, we are creating, recovering jobs, participation rates going back up. So that's a good thing. These kinds of reports come out on a monthly basis, and there's usually a lag of a few weeks or even a month. But we have some other things that are called high frequency indicators, which come out weekly or even daily, that give a fresher read on the economy. So we can look at a couple of these. Over on the left is a measure of credit card spending. It's the JP Morgan Chase credit card tracker. There are two lines there, but what's really important is the annual rate above 2019, that's that blue line, is only up 0.7% from the pre-COVID trend. In other words, people aren't spending a lot with credit cards. And that's maybe good for consumer balance sheets because they don't get in debt, but we need to have consumption to keep the economy going. Over on the right is TSA throughput. Each line is a different year. The blue line is 2019's, quote, normal times. The brown line is 2020, where everything collapsed. 2021's better. And then the yellow, 2022, is just about back at pre-pandemic levels. So TSA throughput is pretty much back where it was. Now there's a little tiny red dot on the left that says 2023. You really couldn't say much about it at that point, but it's okay. A couple others that we look at are the chart over on the left, which is open table seatings. And we compare that to 2019, again, the quote normal times. See the brown line, 2021, couldn't get quite back to pre-pandemic. The yellow line, 2022, did. But now the blue line over on the left, 2023, it's, we're in the middle of January. It's a little hard to say, but it has dipped back a little bit below pre-pandemic levels, so it's okay, but it's not exciting. And then finally, another measure of the economy that's pretty fresh is hotel occupancy. That's that sort of green line there in that circle. And it's above that pre-pandemic level, but I would call it uninspiring. So we haven't seen really a whole lot of recovery there. Positive, okay, glad about that, just not great. Now, there are a